Have you ever witnessed a business reporting hundreds of millions of dollars in revenue only to file for bankruptcy? It sounds absurd, but glamorous financial reports cannot conceal a structure that is fracturing from within. The answer to this collapse lies in a core element the masses often ignore when looking at the surface. It is not flashy revenue or the profit figures recorded in the ledgers. It is the actual cash flow, the sole lifeblood that maintains the operation of an organization. A body may possess a robust exterior, and a company may launch brilliant marketing campaigns, but when the blood stops circulating, the system will shut down. The crowd is always deceived by superficial growth metrics, forgetting that the silent cash flow is the true master of the game. The ability to control the actual money sitting in the safe is the dividing line between an enduring empire and a forgotten name, the greatest naivety of those newly stepping into the business world is the desire for explosive growth at any cost. They view booming sales as a signal of greatness without anticipating the pressure on working capital. In financial mathematics, selling more goods means you must spend a larger amount of cash to recapitalize. The period from when you must pay suppliers to when customers actually pay you is a black hole that can drain all resources. Look at the historical lesson of the fashion brand Nasty Gal in 2016. They were once celebrated as a global phenomenon with revenue surpassing the $100 million mark, only to file for bankruptcy protection at the very peak of their fame. When orders surged uncontrollably, they were forced to advance millions of dollars for production facilities and warehouse systems. Meanwhile, the cash flow from customers trickled in and could not timely compensate for the expenses that had already left their accounts. Overheated growth creates a massive liquidity vacuum, causing their bank accounts to deplete faster than their pace of sales. The paradox of capitalism is that you can entirely fail within your own success. Blindly pushing sales without a solid foundation of reserve capital is like flooring the gas pedal of a car with no brakes. That explosion does not bring power. It merely pushes the business into a long slide toward insolvency. Many business reports are, in reality, just clever accounting techniques designed to soothe investors. Paper profits and actual cash flow are two entirely different concepts that the crowd constantly conflates. You can issue a massive invoice, record an impressive gross margin on the income statement, and feel like you are winning. However, if your partner delays payment, that profit is merely an illusion with no practical value. The giant retail conglomerate W.T. Grant was once an unshakable monument in America. They consistently reported positive profits for a decade, painting a perfect financial picture to maintain their stock price. To stimulate sales, they loosened their credit policies, allowing customers to make purchases on debt with ease. They recorded these credit sales as immediate revenue, creating a beautiful profit margin to satisfy the expectations of Wall Street. But reality knocked on the door when the majority of their customers never paid off those debts. Real cash never returned to the company accounts, rendering the profit numbers on paper meaningless. Book profits cannot be used to pay employee salaries, cannot settle utility bills, and cannot buy patience from the banks. When the safe is empty, even the most dazzling numbers must give way to the collapse of a structure once thought to be great. Failure does not always stem from misguided macroeconomic strategic decisions. A giant machine is often stalled from within by the rust of seemingly insignificant fixed costs. A few $dozen for management software, a small monthly renewal fee for an email marketing platform, or a cloud storage service sounds perfectly reasonable. Business owners often overlook these trivial expenses, assuming they are not worth the attention. But the danger lies in the compounding power and the repetitive cycle of automated subscription services. When dozens of registration fees are automatically deducted at the beginning of each month, They create a financial leak that is hard to control. Countless businesses have lost tens of thousands of dollars each year merely to maintain technological tools they rarely utilize. Those tiny expenses are like a colony of ants, patiently gnawing at the foundation of a building until it can no longer stand. The euphoria of upward trending revenue charts is always the perfect curtain to conceal reckless borrowing decisions. When money flows into the system, arrogance pushes leaders to make hasty expansion choices. They begin borrowing millions of dollars to hire more personnel, expand luxury offices, and flaunt their status. They believe the current growth momentum is eternal and that the revenue of tomorrow will easily shoulder the debts of today, the downward spiral of the co-working startup. WeWork is the clearest proof of a debt trap disguised by expansion. This company was once valued at up to $47 billion through a strategy of continuously burning cash to dominate the market. They used borrowed money to sign expensive, long-term property leases lasting 10 to 20 years. This colossal risk was carefully hidden by a constantly growing short-term revenue stream from tenants renting desk space. But mathematics shows no mercy when the economic cycle begins to reverse. When the market experienced turbulence and customers simultaneously cancelled their short-term lease packages, the revenue mask immediately fell off. The income column rapidly declined, yet the fixed debts from long-term leases still stood tall, demanding payment. This liquidity pressure brought down their entire illusory valuation, turning a tech unicorn into a classic lesson in wastefulness. Among amateur investors, many consider keeping idle cash in a bank account to be a waste of capital. They are obsessed with continuously pumping money into the system in exchange for growth, believing that money must always be in motion. However, the financial elite understand a much deeper rule. Reserve cash is not dead capital, but the ultimate risk management tool. The readiness of cash is a form of silent power capable of deciding the outcome in the most difficult moments. When economic downturns sweep through the market, corporations without contingency funds are pushed to the wall. They are forced to sell off assets at dirt-cheap prices or accept emergency loans with unreasonable interest rates just to survive. Meanwhile, giants like Apple always maintain a treasure trove of tens of billions of dollars sitting quietly in their safes. They do not rush after petty, profitable opportunities, but patiently observe the shifts of their competitors. When the market panics and fragments, that massive amount of cash transforms into the most potent acquisition advantage. They use this very defensive resource to acquire promising technologies and buy top-tier human resources at remarkably low prices. A contingency fund allows them to walk calmly through a crisis, simultaneously seizing market share from the hands of those who just abandoned the game. Cash not only protects them from risk, but also serves as a launchpad to solidify their leading position. The boundary between an enterprise rising to become a legacy and a company fading into silence does not lie in the ability to generate revenue. Revenue may attract the gaze of the media, and reported profits may bring complacency to shareholders. But only the maintenance of a solid, positive cash flow decides whether you are allowed to remain on the business chessboard. An exceptional manager is never deceived by flashy numbers drawn up to please the crowd. True financial independence only begins on the day you measure success by the actual cash flowing into the safe. It requires strict discipline to reject revenue that does not bring in real money and to cut the expenses that are silently weakening the organization. When you stop chasing the illusion of growth and start establishing absolute control over every flow of capital, you truly take mastery. No prosperity is built on looseness. Every sustainable structure must be protected by the discipline of cash flow.